Hello everyone, my name is Blaine Pearson and I am an instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to look at the dividend discount model. To begin, let's first define what the dividend discount model is. You may also see it presented as DDM. So what the dividend discount model is it is a method to value a company's stock price. So it answers the question, as you can see at the bottom, what is the intrinsic value of the stock, and compared to the current stock price, is it overvalued or is it undervalued? So the constant growth DDM, or the Gordon growth model, assumes that the dividend grows at a constant rate given by G. Now, the DDM or the Gordon growth model are synonymous terms. You may see it presented as either one as well. So here in its basic form is the formula. And what this formula is, it is a very simplistic model, a very simplistic stock valuation model to give us an intrinsic value of a stock. So let's break this formula down. This D1, D subscript 1, is just simply the next period's dividend. The R is the required rate of return we as an investor have on the security. And the G is the current dividend growth rate. V given here is what we're trying to find. This is the intrinsic value of the stock. Let's take a look at an example. A stock recently paid a dividend of $5. Currently, this stock is priced at $90. The dividend growth rate is 5%. Your investor requires a 10% rate of return on this investment. So what is the intrinsic value of the stock? And then is this stock over or undervalued when compared to the current price of $90? So what we first have to do is we're given D subscript 0. We're given the current dividend payment of $5. Because our model says that we need to look at next period's dividend, we got to project out the growth rate of 5%. From there, we can take the 10% and subtract the growth rate as our denominator. It looks something like this. So the $5 dividend payment times 1.05 to give us D1, or the next period's dividend, divided by the required growth rate, so the growth rate that the investor requires, minus the growth rate of the dividend. So let's take a look at another example. USA stock paid $2 in dividends in the current year. If the dividend has been growing by 3% per year and your discount rate is 9%, what price should you pay for a share of USA stock? Please pause the video and attempt a solution. Your dividend discount model formula should have given you an intrinsic value of $34.33 a share. We did this by taking the $2 in dividends, timesing it by the growth to get D1, and then dividing that by the difference between the investor discount rate and the growth rate of the dividend. Moving on, Can stock is expected to pay $3 in dividends next year. If its dividend has been growing by 2% per year, and the investor, or your, in this case, discount rate is 8%, what price should you pay for a share of Can stock? Please pause the video and attempt to arrive at a solution. Here, you are actually given D1. Because Can stock is expected to pay $3 in next year, we do not need to project out the dividend because it's giving us next year's D1 in this example. All we need to do is take the D1 dividend and divide it by the difference between the discount rate and the growth of the dividends. Now, if we solve this solution, it gives us a price of $50. We would purchase this stock if the stock was less than or equal to $50. If, for example, the price of canned stock was selling at $40 per share, using our basic model, we see the intrinsic value is $50 per share. We would purchase a security and attempt to capture that $10 difference. Now, if, for example, canned stock was trading at $70 a share, we would not purchase the stock. This is because using this very basic stock valuation model, the price of the intrinsic value of the stock is less than what the current market price is, making it a poor investment. Again, this is Blaine Pearson, and in this video, we covered the dividend discount model. Thank you for watching.